Greetings, my name is Kyle Soley and with me is Sebastian Watt. I'm a partner at Reed Smith and Sebastian's also a lawyer at Reed Smith. And Sebastian and I are doing a four-part series on federal tax reform and how it impacts state tax. In our first video, we touched on the transition tax and we touched on the actual cash repatriation and factor representation. In today's video, we continue with the transition tax and we're going to talk a little bit about the unitary business principle and how the unitary business principle plays out in the context of a transition tax that brings us back to 1987 for purposes of determining the earnings and profits that are included in income. So let's start a little bit about what's the unitary business principle. It is the linchpin of apportionability, and of course what that means is the only reason a state can impose tax on income is if the state has a connection to the income. And the way a state has connection with the income is that income, even if it's connected with activity out of the state, if that activity is unitary with the activity in state, then the state can tax it. Of course, you need to use apportionment, so they only get their share of the unitary business, but the business has to be unitary. So the issue that we run into with the transition tax and the cash repatriation, frankly, as well, is we're dealing with income that was earned 30 years ago in some cases. So how do we go about applying the unitary business test to that income? So the first question we have is, well, what if I'm unitary today, and I've been unitary for a while, but there was a long portion of my company's history when I was not unitary with the foreign subsidiary that's generating the earnings. So we have an example, and we say, look, what if from 1987 to 2010, I had a manufacturing company who was making widgets, but that was what was going on in the US, but I had this foreign investment, this foreign subsidiary that was leasing cars, unrelated business, not unitary. And over that period of time, the foreign business generated $500 of earnings and profits. Then in 2011, we had a reorganization, we did something, and we ended up in a situation with our subsidiaries pivoted to the same business we're doing domestically and ended up being integrated with the business we're doing domestically and became unitary and then earned another $100. So we have a total of $600 of earnings and profits, and that is the accumulated earnings and profits that forms the basis of the transition tax. What do we do then? Well, our view is, it's pretty clear that when that amount, if it would be included in the state's base, we talked a little bit last time about states that would include that amount in their base. If it's included in the base, either by way of the transition tax or by way of the actual cash distribution, then only the $100, 1/6 of that income should be included in the state base, because the other $500, the other 5/6 of the income should be excluded because it's not unitary. So that is an important consideration to take into account, especially in those states that may include either part of the transition tax or part of the cash distribution in income. And we talked a little bit about those states in our first video. The other issue is a little bit different, but really produces, I think, substantially the same result. And that is this: what if I was unitary in the past? For 23 years, I guess, in our example, we're unitary. And then we restructure and we become non-unitary. Well, here's the issue. I don't know that it's a unitary business principle that prevents the state from taxing the income. After all, the income has some connection with the state because it was unitary with the domestic operations. Okay, so we have the U.S. operations, unitary with the foreign operations. There's a connection with the taxing state. Now, maybe there's an apportionment question. Which year's apportionment do you use? Illinois, for example, has suggested to us that you would use the apportionment in the year in which the earnings was earned. Okay, and that may be an okay answer, but here's the problem. Here's another problem for you. If you became not unitary recently, and again in our example, and starting in 2011, and for 6 years thereafter, you're not unitary. Can the state in 2017 or 18 essentially change its law, either by conformity to the federal law or by enacting its own, adopting the federal provisions, and go back 8 years and tax income that was really connected with the state 8 years ago. And here we have serious due process concerns with the state's ability to do that. It's not really as much a unitary business concern as it is a due process concern. The state tries to go back and enact a law or conform to a law that allows it to go back and tax activity that happened 7, 8 years ago. That may go beyond the look-back period that would be allowed for due process purposes. Sort of an analysis like the analysis of retroactivity under the Carlton case and so on. So again, when you're looking at the transition tax and repatriation issues, something to take a look at is how it was my business, unitary or not, with the foreign subsidiary over the course of time. Now with that, I'm going to turn it over to Sebastian, who's going to talk with us a little bit about some mitigation alternatives for the income that may be included in your base.
Sure, so if you are including some of the deemed repatriation income in your tax base, you may be able to petition and get alternative apportionment. So alternative apportionment sort of applies when a state apportionment formula does not properly reflect the taxpayer's business in the state. And when you're including millions of dollars or whatever it is of deemed repatriation income, applying the state applying the state formula to that income, it's a good chance it's not going to reflect your activities in the state, because presumably all that foreign income is as a result of activities outside of the United States entirely. So one thing to keep in mind is that alternative apportionment is always constitutionally allowed. So when you're looking at state statutes and figuring out whether you can take an alternative apportionment position, some state statutes aren't entirely clear that the taxpayer can assert alternative apportionment. For example, in Maryland, the statute provides that the comptroller may allow three-factor apportionment to clearly reflect the income allocable to Maryland. So it doesn't really sound as if the taxpayer can assert alternative apportionment, but it's important to remember that a taxpayer may always be able to take the position that it can assert alternative apportionment if the state's standard formula doesn't reflect its income in the state. So with that, I'll turn it back over to Kyle to talk about another approach to mitigating the deemed repatriation.
Yeah, so one of the things we wanted to talk about was, and this has been, there's been a lot of lore in the taxpayer community about the Kraft case. And how does a Kraft case interact with the transition tax generally? And what we wanted to do is we wanted to talk about it in the context of an example in New Jersey, to make it real, to actually bring home a real example of a Kraft violation. But really, the Kraft rule is this. A state can't prefer domestic commerce over foreign commerce. And remember, the Kraft case was Iowa allowed a deduction for a dividend received by Kraft had it been from a domestic subsidiary, but disallowed it if it had been received from a foreign subsidiary. And the United States Supreme Court said that discrimination, that distinction between foreign and domestic subsidiaries violated the Foreign Commerce Clause and was unconstitutional. Well, let's consider New Jersey. We have an example in New Jersey because New Jersey has a quirky rule. New Jersey has a rule that says if you receive a dividend, you get a dividend received deduction, provided you meet an ownership test. You get a dividend received deduction. But you have to order your net operating loss deduction before your dividend received deduction. Another way that states just routinely abuse net operating loss deductions, and New Jersey is no exception to that. So it makes you take your net operating loss deduction first. Okay, and that's important for this reason. New Jersey has historically taken the position that subpart F income will be treated as a dividend for purposes of the dividend received deduction, which in a way is a good thing, right? Because generally, unless you're in this net operating loss position, you like to be able to deduct your sub F income, and New Jersey lets you do that by treating it as a dividend. The problem is, though, if you have a net operating loss, and you may say, well, okay, so why is that? Well, remember, if you need to take your net operating loss deduction first before your dividend received deduction, then what you're going to do is you're going to absorb net operating losses when you distribute a dividend, okay? Because you've got to take the net operating loss against the dividend first before you can cover it with the dividend received deduction. So how does this play out? You say, okay, that's a lot. How does this play out in federal tax reform? Well, let's take the example of a parent company that has a domestic subsidiary, and the domestic subsidiary has $100 of accumulated E&P. In other words, the domestic subsidiary has the kind of E&P that would be included in the transition tax base had it been a foreign subsidiary. Well, what's the result? Well, of course, there's no result. New Jersey is a separate company state, okay? And therefore, the income of the separate subsidiary is not included in the base at all. So long as it's not distributed, it's not included in the base at all. There's no concept of a domestic sub-F income. And therefore, the taxpayer, when the subsidiary earns the $100, there's no impact at all. That taxpayer, if it has a $100 NOL, if the parent has a $100 NOL, the $100 earned by the subsidiary has no impact whatsoever, even again if it's the kind of income that would have been in the transition tax base. But now let's compare that with what happens if your New Jersey company has a foreign subsidiary. Well, now, your foreign subsidiary, as we know, if it has accumulated earnings, that accumulated earnings is what makes up this whole transition tax base. Same example, but you just have a foreign subsidiary that earns $100. Well, that's going to be under Section 965. That's going to be Subpart F income. Now, New Jersey generally would say, well, that's okay. We'll give you a dividend received deduction. But of course, as we're talking, New Jersey would require you to first, before you get to use the dividend received deduction, you've got to use that NOL deduction. So you would have to use the NOL deduction. And in our example, if you had $100 of earnings or NOL carryover at the parent level, and the subsidiary had $100 of accumulated earnings that turns into sub-F, what happens is you absorb the $100 of NOL at the parent level. And what that means is if you do a side-by-side comparison, exact same situation, $100 earned by the domestic subsidiary compared to $100 earned by the foreign subsidiary, the result is different and worse for the $100 earned by the foreign subsidiary, which again, going back to our Kraft rule, we think clearly violates the Kraft rule because what New Jersey is doing is treating the foreign subsidiary worse than it would have treated the domestic subsidiary.
All right, so I'm going to talk a little bit about this potential double benefit that you may have heard tax practitioners talking about. So first we'll go through an example as to how a taxpayer could result in potentially getting a double benefit as a result of the deemed repatriation, and how strong that argument is in some states. So first, how does this potential double benefit work? Well, it's a result of the mechanics at the federal level combined with a state dividends received deduction. So at the federal level, 965A says you have an inclusion in gross income for your post-1986 undistributed earnings of your foreign subsidiaries. That amount is included in gross income. 965C then provides for a separate deduction from gross income. We're not going to get into the calculation of that income. It's a little bit complex, but let's assume for these purposes that it's $57, which it very well could be. At the end of the day, your federal taxable income as a result of the deemed repatriation would be $43. And so that's the state starting point if a state conforms to the deemed repatriation. So at the state level, you start with $43 and you apply the state dividends received deduction. Now the question is, what does that state dividends received deduction apply to? Now 965A told you to include $100 in gross income. So arguably, the amount of the deemed dividend is the full $100. You didn't, mechanically at the federal level, you didn't take your $100, subtract the 57, and include the net amount in gross income. Rather, you included the full $100 in gross income. So as a result, if you apply the state dividend received deduction as it mechanically works, you could potentially result in a $57 loss. So New York, for example, recognized that applying the mechanics of the federal rules combined with the mechanics of their state statutes would result in this potential double benefit to taxpayers. And this is because New York would have conformed to the deemed repatriation as a result of conforming to the Internal Revenue Code. Just like in our example, as a result of that conformity, the taxpayer would have gotten the 965C deduction, and the taxpayer would have also gotten an exclusion for 100% of it's 965A deemed repatriation income. So the New York Department of Taxation recognized this problem and recognized that this is the mechanical result. They told the legislature, and the legislature fixed the problem in the New York budget bill that was recently passed. So that's an example of a state that recognized and agreed that mechanically a double deduction would result, but fixed it by statute. A number of states have not addressed and may never address the potential double inclusion benefit. But even applying the mechanics of current law, the strength of taking the double benefit in states is going to differ depending on a number of factors. So we use Pennsylvania. We'll kind of run through a couple of those factors. Pennsylvania is a good example because it conforms to the Internal Revenue Code on a rolling basis. So as a result of conforming to the deemed repatriation, taxpayers will get the benefit of the 965C deduction. And then taxpayers get, if they own 100% of their subsidiary, they also get a full dividends received deduction that applies to Subpart F income. So just like in the example above, the question becomes, how much do I get to deduct when applying that state dividends received deduction? So Pennsylvania starts with taxable income returned to the federal government. So as I said, we're a rolling conformity state. But the Pennsylvania statute also provides the dividends received deduction is allowed to the extent that dividend is included in taxable income. So what does this mean? Well, as I said before, it's clear that the entire, going back to our example, the entire $100 was included in taxable income. There's a potential argument that the net amount of that dividend was only the dividend after the subtraction for the 965C amount. Going back to our example, the net of $43. So that's just something to look out for. Not all states have this language. Some states' language is more explicit. For example, Illinois specifically provides that their dividends received subtraction only applies to amounts included in taxable income. So the language is a little bit stronger. Double deduction, result might be less likely. Another thing to watch out for is, in Pennsylvania, for example, the dividends received deduction applies to Subpart F by case law. The statute merely provides for deduction for Subpart F, or for dividends, not Subpart F. Pennsylvania courts, however, have said that the reasoning behind providing taxpayers the dividends received deduction was to exclude all income from subsidiaries, period. Therefore, Subpart F can also be deducted under the DRD. But because that rule is not statutory, it doesn't flow from the pure mechanics of the statute, the position could be a little bit weaker.
The courts giveth and the courts take away.
Exactly. That's different than New York, and say Florida is an example of another state that, like New York, provides for a statutory deduction for Subpart F. And when mechanically you're required to subtract the entire amount of the Subpart F income, you could be required to deduct the entire $100, going back to our example. So we're going to switch gears. So that wraps up our section on deemed repatriation. We're going to switch gears and talk briefly about GILTI. So most state legislatures have not responded to GILTI yet. Unlike the deemed repatriation, which is a 2017 issue, GILTI is not going to hit state tax returns until 2019 generally. Of course, it matters for financial reporting purposes, so you might care a lot about GILTI and how states are going to react to it. So when looking at whether a state conforms to GILTI and is going to include this deemed tax on a U.S. taxpayer's foreign intangible income in the state tax base, you first need to ask whether the state conforms to the provision. And the analysis is going to be similar to the rolling conformity, static conformity discussion that we had at the beginning of our first video. An important nuance to GILTI is that at the federal level, the GILTI inclusion is offset by a 50% deduction and foreign tax credits. Of course, foreign tax credits are not available at the state level. But the question is whether states will conform to this 50% deduction for GILTI income. But that deduction is a special deduction And as we know, a lot of states conform to the Internal Revenue Code's definition of federal taxable income before special deductions. So you might have to require guilty income, and you might never get that 50% deduction, which could be significant. It's something to pay close attention to when you're doing sort of a conformity analysis. Similar to the deemed repatriation, you should be able to sort of mitigate this inclusion using the same arguments as the deemed repatriation. So for example, getting factor representation, or not including income from subsidiaries or assets that are not unitary with your in-state business. Probably the biggest question is whether the state dividends received deduction applies to guilty. We've all just assumed over the years, and most states do provide, that a state dividends received deduction allows you to subtract subpart F. And the reasoning for that is because subpart F is generally treated as a dividend for most purposes of the Internal Revenue Code, which makes sense because subpart F is determined in relation to the earnings and profits of a corporation. And earnings and profits is defined in the Internal Revenue Code as a distribution from earnings and profits. So why does that matter for guilty? Guilty is determined without regard to earnings and profits. So unlike subpart F, it really doesn't look or feel like a dividend. So it might, the position or the conclusion that it is automatically deductible under a state's dividends received deduction is not as easy to make. That said, the conclusion is really going to vary by state. As I said before, Pennsylvania's dividends received deduction applies to subpart F as a result of case law, and the reasoning in that case law could equally apply to guilty. The Pennsylvania court said that the dividends received deduction should apply to subpart F because the dividends received deduction was intended to exclude all income from subsidiaries not otherwise deducted. They didn't say anything about earnings and profits. It's just all income from subsidiaries, and guilty is income from subsidiaries. So there's, a good position in Pennsylvania that the dividends received deduction does apply to reduce guilty.
And apart from all of this, there's a serious Kraft problem with guilty, because we're only talking about foreign items, right? So it sort of naturally would fall in that same sort of analysis where you wouldn't be doing the same thing with a domestic subsidiary. So in a separate company state in particular, and I guess also combined states as well, it's something significant to look at, that Kraft issue.
Right, just like the deemed repatriation, guilty would only require an inclusion of income from a foreign subsidiary, not a domestic subsidiary. So. We'll just touch on one other nuance as it relates to guilty that the taxpayer should be aware of. When guilty is combined with state add-back provisions, there is a potential for double taxation. Take for example, a U.S. taxpayer that's located in New Jersey and has a New Jersey business. And that has a foreign sub, let's say a Brazilian foreign subsidiary. And say the income of that New Jersey parent is $1,000. And the New Jersey parent makes a royalty payment to the Brazilian subsidiary for use of the Brazilian subsidiary's intangible property. Well, if that Brazilian subsidiary's only income is the $100 of intangible income, there's a good chance that income to the Brazilian subsidiary is going to be included in the U.S. tax base, included in the New Jersey taxpayer's tax base as a guilty inclusion. And so when you calculate your New Jersey taxable income, you're going to, for federal purposes, the starting point is going to be $1,000 because you've taken a royalty deduction and you've had to add back a guilty inclusion. Now when you then apply New Jersey's add back, the add back is going to tell you that you need to add back the royalty expense because it was an expense to a related party in a foreign country that does not have a comprehensive tax treaty with the United States. And so you're going to have to add back that $100 of royalty.
And that would be Brazil.
And that would be Brazil, exactly. And so you're going to have to add back that $100 of income again. But you already added back that $100 of income as a result of guilty that was included in your federal tax base starting point. So now you've only earned $1,000 of income, but your New Jersey tax base is going to reflect $1,100 of income. So this is a nuance that is potentially applicable in a number of states with add backs, and it's not readily apparent. So it's something to watch out for as you move consequences of this new GILTI tax.
Yeah, and it may be that in addition to the Kraft argument with regard to GILTI, that this may make the add back itself unreasonable if you're already picking it up. You'd otherwise already pick it up with the GILTI.
Absolutely.
So that brings us to the end of our second video in our four-part series on federal tax reform and state taxes. Please join us if you can for our third video, where we'll be talking about bonus depreciation, and our fourth video, where we'll be talking about rolling conformity states and our argument that in many of them, they're not really rolling conformity at all. Thank you.